Welcome to the Deep Dive. If you're looking for the quick, no-nonsense summary of Orkla ASA's latest earnings, you're definitely in the right place.
Yeah, we've done the digging for you.
Exactly. Through the Q2 FY25 results. No need for you to wade through it all.
Absolutely. And for a company like Orkla, so diversified food, snacks, health, even paints getting into these reports is, well, it's crucial. You get insights beyond just the headlines. It's a shortcut to really understanding what's going on. And these results, they dropped pre-market July 14th, 2025.
Okay, let's unpack this then. What were the key headline figures, the ones that really jumped out, revenue, profit, compared to market expectations?
Well, the numbers were pretty solid, actually. Revenue came in at NOK 17.65 billion, which topped the consensus estimate of NOK 17.29 billion by about 2%.
Not bad.
And their adjusted EPS, earnings per share, that was NOK 1.56, that beat the street's view of NOK 1.48 by roughly 5%.
Okay, so beats on both top and bottom lines.
Yep. And we saw organic growth accelerate a bit to 3.8%, plus the adjusted EBIT margin held steady at 10.3%.
Which is pretty impressive, right? Given all the talk about raw material costs.
Exactly. Considering those headwinds, holding that margin is quite good. So yeah, a modest beat overall.
Right. Decent performance, sounds like.
Yeah.
But you mentioned the market reaction was, well, quiet.
Yeah, relatively quiet. It's interesting. The numbers show steady execution, like you said, decent beat, but the reaction was pretty subdued.
So maybe the market already expected this, priced it in.
That seems to be the case. It's that classic expectations game, isn't it? The low single-digit beat was fine, welcomed even, but I think the benefits from their restructuring efforts were largely factored in already.
Oh, okay.
And the shares actually faded a bit because, well, the guidance was just reiterated. They didn't raise expectations.
I see. So no new positive surprises on the outlook front.
Exactly. And if you look at their peers, Nordic staples like Carlsberg, AAK, they were flat, maybe slightly higher. So it suggests Orkla's dip was more company-specific. Okay. But you got to remember the stock is still up quite a bit, like roughly 25% over the last 6 months.
Wow. Okay.
Yeah, helped by that hydropower asset sale back in April and their capital markets update in May, where they outlined that pretty ambitious 12-14% total shareholder return target.
Right.
So maybe some profit taking plus a stronger Norwegian krone lately, that's probably tempered things a bit.
Got it. So connecting this back to their bigger strategy.
Yeah.
That 3.8% organic growth, where did that come from? And the 6% jump in adjusted EPS, how does that fit into their capital markets day targets?
Good question. So that organic growth, it came from price increases, but also a return to consolidated volume growth, which is positive. And the 6% EPS growth, yeah, that aligns with their direction.
And the CEO.
Right. The CEO, Nils K, Selsey, he reaffirmed their targets for 2024-26. The margin and return on capital employed, ROCE.
Did ROCE change?
Actually, yeah, it increased slightly to 11.8%. That's a good sign for efficient capital use. And what's important, I think, is his clear signal about focusing the portfolio more tightly, especially after selling off those non-core bits like the POB group in March and the hydropower stuff in April.
Streamlining things.
Exactly. Simplifying the structure, focusing on core areas. And even with input costs still volatile, they kept the FY25 guidance intact.
Okay.
Oh, and that rolling 12-month EBIT adjust margin for the consolidated portfolio companies, that hit 10.3%, up 6 percentage points over the last year, shows discipline.
That's a solid overview of the strategic side. Now let's zoom in a bit. You mentioned varied performance across the portfolio companies. Where do we see the wins and where were the tougher spots?
Right, definitely a mix. Let's start with Orkla Food Ingredients. They had a strong quarter, really strong, 9.2% organic growth.
Wow, 9.2%.
Yep. Driven by good top-line growth, and they successfully wrapped up a cost program in their sweet cluster that's now closed.
Okay.
And they also made an acquisition, Levasub, a Belgian ice cream ingredients maker. Should strengthen their position there.
So food ingredients sounds like a real bright spot. What's working so well there? That cost program, the acquisition. Can they replicate that elsewhere?
Well, it seems like a mix of really focused execution on efficiency. That cost program proves they can manage operations tightly and smart, targeted M&A with Levasub.
Right.
The learning is probably about that precision, both in cost control and finding acquisitions that fit well and add value quickly. Whether it applies everywhere is tougher, depends on the segment, but the principle holds.
Okay. But yeah, not all segments were hitting it out of the park. There was a big story around Orkla Health, wasn't there? Sounded like a real challenge.
Yeah, this is definitely a critical one to watch. Orkla Health had a weak quarter. Underlying EBIT was down 21%.
Ouch. 21%.
Yeah. Management was clearly disappointed. They talked about broad-based negative volume development.
So people are buying less.
Seems like it. And here's a key thing. They increased their spending on advertising and marketing, A&M, but it didn't really deliver results.
Spending more, getting less.
And their SG&A, selling general admin costs actually outpaced sales growth, so not efficient.
Right.
But crucially, there's a new CEO, Matt, coming in August, and he has a very clear mandate. Fix this, address the challenges, close that performance gap. So all eyes on Orkla Health now.
Definitely one to track. Okay, what about Orkla Snacks? Always interesting with those cocoa price pressures. How did they do?
Snacks saw 4.3% organic growth. Positive signs from biscuits and snacks, but chocolate volumes were lower.
Expected maybe with cocoa?
Probably. Despite that continued pressure from high cocoa prices, their underlying EBIT was flat, which honestly in this environment, holding flat is kind of an achievement.
Yeah, fair point.
They've been working on things like harmonized recipes, reducing fixed costs, trying to offset those headwinds, and looking ahead, they're planning the Bubs US launch for Q3. That's more of a longer term play though.
Interesting. Okay, moving out of Europe. Orkla India. That seemed like a positive story.
Yeah, Orkla India is definitely a bright spot. Underlying EBIT adjust growth was impressive, 20% if you exclude government grants.
20%.
And 6% organic revenue growth, again, excluding grants. But the big news really was in June, they filed a draft hearing prospectus with the Securities and Exchange Board of India.
So thinking about an IPO maybe? Unlocking value?
That's exactly the signal, actively exploring ways to unlock value there. An IPO could be a major catalyst down the line.
Okay. And quickly, any other segments worth a brief mention? Positive or negative?
Yeah, a couple. Orkla Home and Personal Care is still on a positive track, 8.5% organic growth, consistent demand there.
Good.
Orkla Foods had just 1% organic growth, lower activity in Norway, apparently. They did increase ad spend, though, so maybe investing for future demand. We'll see how that pays off.
Right.
And the European Pizza Company, they saw 1.2% organic growth. Seems like consumer sales momentum is okay, and they're controlling costs.
Okay, got it. So shifting back to the broader picture, financial health macro stuff. What do the call tell us there? Cash flow, debt, and what are they saying about input prices or interest rates going forward?
Right. So cash flow from operations in the first half was NOK 2.4 billion. That's actually down about NOK 0.4 billion compared to last year.
Why the dip?
Mainly due to increased net working capital and also higher net placement investments. On the capital allocation side, debt levels did tick up a bit.
After the dividend.
Exactly. After that NOK 10 billion dividend distribution, they ended the quarter with net interest-bearing debt at 2 times EBITDA, or 1.6 times if you exclude Orkla Food Ingredients.
So manageable levels still.
Yeah, it seems manageable for a company this size, even with the dividend payout. For input prices, they expect raw material prices generally to stabilize in 2025, except cocoa. That's still the big outlier, the persistent headache. And on interest rates, management didn't offer a ton of crystal ball gazing. They sort of drew parallels to the financial crisis experience, suggesting, demand for branded goods came back pretty quickly back then when rates fell, but admitted their historical perspective is limited.
Fair enough. Okay, before we wrap, we always like to do our This Is Not Financial Advice segment. Toss around some, let's say, outrageous but plausible ideas based on the call. Just thinking out loud. What springs to mind this time?
Okay, well, keeping in mind this is definitely not advice, how about this? Consider a pair trade.
Ooh, okay.
Go long or KLA equity. But the bet is specifically on the turnaround potential in that Orkla Health segment we talked about.
Right, the laggard.
Exactly. Pair that long position with the short on, say, a slow-moving established competitor in the consumer health space. Someone in a mature market may be lacking a clear growth catalyst.
Okay, what's the thinking there?
Well, the core idea is Orkla Health is currently a known underperformer, a drag. But now they have a new CEO specifically tasked with fixing it, closing that big performance gap. So, given how it's underperforming now and with new leadership focused on it, any meaningful improvement there could be a substantial, maybe even asymmetric, positive re-rating for Orkla overall.
A hidden catalyst? Sort of.
Potentially. And the short leg, the competitor, acts as a hedge. protects against broader market dips or sector headwinds. So it becomes a relative value play, really, betting on an internal company-specific turnaround story that the market might be mispricing right now.
Interesting. A play on the Orkla Health fix-up.
Oh.
Okay, plausible, maybe a bit outrageous. I like it.
Just an idea to mull over.
Definitely.
Yeah.
So just to recap Orkla's Q2 then, we saw that modest beat, financially disciplined execution of the strategy seems clear, and that ongoing portfolio reshaping, the divestments, acquisitions, it's all happening.
Absolutely. And the key things to watch going forward, definitely the turnaround effort in Orkla Health. That's huge. Also, keeping an eye on Orkla Food Ingredients and Orkla India, can they sustain that strong growth? Especially India with the IPO potential. And of course, how management navigates those ongoing input costs, particularly cocoa.
Always cocoa.
Always cocoa.
All right. And just the usual reminder, everyone, this deep dive is purely for informational purposes. Definitely not financial advice.
For sure.
Yeah.
And maybe leaves you thinking, what signals from this call tell us about broader consumer goods trends? And, how quickly can a focused strategic shift, like the one potentially starting in Orkla Health, really impact a big, diversified company's bottom line? Something to ponder.